The research that Freya and I are going to share today is about the challenge of bringing legal norms to bear on the use of algorithmic decision-making, particularly in the context of access to high-cost online loans. So this research brings together Freya's interest and expertise in equality and consumer law with my interest in theories of judgment and relational justice. We share sort of animating political and methodological commitment to centering income inequality in our analysis. And in this project, really our overarching concern is to use the context of high-cost online lending to demonstrate the need for a robust, reflective, and also interdisciplinary conversation about the legal regulation of algorithmic decision-making in our society. And we've chosen this example partly because it is very complex. It's not obvious what are the sort of justice implications. It shows the complexity of the equality issues at hand. There's intersecting grounds of inequality, the need to attend to the regulation of public and private actors, and the limitations and potential of concepts in anti-discrimination law as a remedy for collective economic and social phenomena such as income inequality and such as, we say, algorithmic decision-making. So today we're just going to share really an overview of our paper so far, some of the things we're thinking about, questions we're working through, and we really look forward to your feedback and questions for sure. So in a moment, Freya is going to explain the role of algorithmic decision-making in online lending and the range of justice and equality considerations that arise there. But first, just a short note on our use of the terms algorithm and automated decision-making. We are interested in cases where automated processes rely on algorithms implemented in software to make decisions of relatively complex kinds, so such as the assessment of credit risk. And for the most part, we use the language of algorithms and automated decision-making without purporting to engage in the technical or certainly not mathematical aspects of those concepts. But there are a few aspects of algorithms as a concept and algorithmic decision-making that are important for our analysis. First, it's important that the algorithms we discuss function by making predictive inferences about human behavior. So these inferences are based on particular sets of data, usually very large sets of data, which is why debates about algorithm are also debates about so-called big data and the way that information is created and analyzed and deployed. So algorithmic decision-making contains a very specific kind of reasoning, one which we say can be tested against legal norms about fairness and equality and justice. Second, algorithms are designed by people in order to achieve particular goals, and as such, algorithms are inherently value-laden. And this is important to note just partly because this fact is really in tension with some of the ways that public discourse around algorithms and just sort of computers in general sometimes proceeds as if algorithms were associated with objectivity or value neutrality. And finally, although algorithms are created by human designers for specific human purposes, their operation can, sometimes by its nature, contain a great deal of uncertainty and opaqueness. So for example, in cases where algorithms are constructed with the capacity to learn or change as they're exposed to new sets of data and make more correlations, human designers and operators may not, and in some cases cannot, understand the rationale of the decision-making algorithm, might not be able to understand the basis on which outcomes are reached. So these characteristics of algorithmic decision-making, its inferential, value-laden, and sometimes opaque nature are important for thinking about how it relates to equality and justice. So what happens when this kind of decision-making is put into practice in the online lending context?
Okay, so So at present, we're focusing on the online lending environment, although some of the concerns that we raise would also arise in the bricks and mortar lending environment. But briefly, online lending would involve a borrower using an online portal, such as a website or a mobile app. And online, they will provide personal information, including their source of income, their bank account information, and they would review and accept a loan agreement. And then they would authorize a loan repayment from their bank account through pre-authorized debits. And then they would have the loan funds deposited directly into their account. And so online lending is very much a growing phenomenon in other jurisdictions. It's much, it's a greater percentage of lending than it is in Canada presently. And it isn't necessarily limited to high-cost loans, right? There are a growing number of online marketplace lenders that offer both low-cost, less than mainstream financial institutions, and high-cost loans. And so, but one of the reasons for the expansion of online lending is both the low cost and the high cost is the use of data-driven algorithms to assess credit risk. And so these algorithms allow online lenders to automate loan assessment, reduce costs, and the loan application turnaround times. And they can, also to be clear, this can benefit both the lender and the borrower. There's a possibility for, by using more data, that there's a potential to expand access to credit to people who might not otherwise have received it under a traditional model. So it's not all bad, is I guess what I'm trying to articulate. But and just before I get into concerns about the data-driven algorithms, especially the concerns that they raise for low-income and racialized borrowers, I do want to point out that the use of algorithms to assess creditworthiness is not new, right? The algorithms that credit reporting agencies such as Equifax or TransUnion use to generate credit scores and credit reports, your credit scores, which is the risk. They were developed in the 1950s, and those algorithms use data that focused on you, on your finances, your debt load, your bill paying history, employment history. And they actually did, at the time, a much better job of predicting your risk than the local banker did. And in particular, the use of algorithms meant that credit actually expanded for a whole group of people, especially women and racialized persons who the algorithms actually eliminated some of the conscious or unconscious bias that many white male 1950s local bankers brought to an assessment of creditworthiness in the absence of other information. So the credit scores that are used by Equifax and TransUnion, they continue to rely on some of this information. And the information that can be in a credit report and that is used in a credit score, it's regulated. And individuals have a right to know what's in their credit report and to have it corrected if the information is not correct. And it's not these traditional credit reports or credit scoring that we're concerned about. And these are not the ones that are being used in the online environment. And also, lenders are not required to use these credit scores and reports. So what we're concerned about is the new data sources and algorithms and the risks that they create for consumers, including correlations that can lead to disparate impacts on consumers from particular groups, or also can penalize consumers with limited data footprints. So, some examples of how these big data sets and the use of data to assess your credit risk can have some negative consequences. One might be that you've applied for a loan and your characteristics might not actually be used in the data source that's used to assess your credit risk. So for example, if I have X characteristic, if we decide that left-handedness is important for assessing credit risk, the data on people who are left-handed that's included in the data source might not actually include me, individually as the left-handed person. The other is that if the algorithm is using data about you to determine your credit risk, and they actually don't have a particular piece of information about you, say the number of people that you support in your household, then it may simply substitute information about the household size of people like you in other respects. So it will use that. Or it might make decisions based on discriminatory grounds. So it might use information about race or gender as a proxy to generate decisions about credit that are infused with racial categorization and social hierarchy. Or the data might not actually be using information about membership in a protected group, but it might have a discriminatory effect. So, and it may raise the cost of credit or deny it to people who are in a protected social group. So an example might be that poor spelling and the time taken in an online application, whether someone read all the terms and conditions, which probably most of us, but that might mean that people are less likely to repay because they're not careful, right? They didn't read all, they weren't careful about how they filled out the form, they didn't read all of the conditions. But it might also correlate with immigrants and refugees who have limited English skills. So that, so depending on how information is correlated and interpreted by the algorithm, it could increase the cost of credit or deny it in ways that raise normative concerns. So the cost of getting it wrong can be quite high for low-income people, right? It can lead to no credit, it can lead to the increased cost of credit, and in an environment where people are increasingly turning to credit just to meet basic needs, that it can have a significant consequences. So the use of algorithms raise some kind of basic or some legal issues. So they raise some privacy issues. Our right to control personal information or to use or to know how it's being used and to correct it, to consent to it. Also raises issues in consumer law, again, about consent and about understanding how decisions are made and the effect and the conclusions that are drawn from it. And it can also raise human rights or anti-discrimination law concerns in terms of, the law has something to say about protecting groups who are in protected categories or the effect of particular decisions on groups in protected categories. But thinking about an effective response is also challenging in part because of the lack of transparency about what data is used and how it's used to generate decisions about access to credit. And so we want to think a little bit more about how to bring legal norms to bear on algorithmic decision making.
So these are some of the frameworks that are sometimes applied to think about how do we legally regulate the use of algorithmic decision making. Here are some of the sort of frameworks that are sometimes used: privacy law, consumer law, human rights law. And in our sort of beginning to engage with the conversations around those frameworks and sort of commentary on them, we sort of encountered the sense that some of those debates about how to regulate algorithmic decision-making are grounded in a particular idea about what law is and what it does. In particular, we found that some debates are oriented strongly towards individual rights as the organizing goal of law, and reflecting what you might call an instrumental view of law. So for example, debating about the plausibility or desirability of banning resort to racial categories in algorithms. For example, like, could we do that in law or should we do that? And we think that that approach does not capture all that is important with respect to algorithmic decision making. It captures some, but not all. So for example, just to give you a sense of what I mean, within those frameworks, it becomes unclear how, or even how you would ask these other kinds of questions, like what's the role of law in the creation of these categories in the first place, the categories that we want algorithms to resort to or not resort to, who benefits from different kinds of efficiencies, and then even how can we use law to foster a greater engagement on these questions of income inequality. So to try to bring in a greater range of questions, we are working through the usefulness of understanding law in relational terms, relying on scholars like Colleen Shepard, who has an idea of inclusive equality, which draws on relational theory. We're interested in ideas of equality and justice that take seriously the role of law in creating and maintaining those social hierarchies, but also potentially subverting them. And so from those kind of relational approaches, we've drawn sort of three important aspects. One is attention to the collective dimensions, both of law and of algorithmic decision making. The second is attention to process, and I think we'll probably hear more about that from a different perspective from Christy. Focus on scrutinizing norms and categories, in addition to when we can sort of press up against those or depart from those norms. So in our last couple minutes, I'm just going to elaborate one kind of argument we're working on, which we think kind of shows the significance of the online lending context and the potential usefulness of paying attention to the legal theory that's underlying some of these debates about algorithms. So for example, on this first theme of attending to collective dimensions, recall sort of Freya's earlier point that some of the regulatory frameworks that we've encountered are oriented towards the value of privacy and control over one's personal information. However, the information that is used to make the inferences about the creditworthiness of particular individuals is drawn from huge sets of aggregated data, none of which might ever be attributed to any particular individual. So it's not clear that the value of privacy is ever even infringed by that whole process. And it's not also clear how access to that information, even complete and transparent access were that possible, would somehow redress the problems at hand. And yet, particular people do bear the costs associated with those inferences, not by virtue of loss of control over their personal information or the tenuous nature of the consent granted to its disclosure and use, though those things may still be legally relevant. Rather, we think that the justice problems faced by people in this situation also arise due to the collective nature of the algorithm and the way algorithms go to work on collectivities of people. So the question becomes, for example, does the operation of the algorithm reinforce racialized or gendered poverty in North America? So just to finish, here's some of the sort of things that we're exploring further as kind of like the next, what our arguments might be. In particular, we want to talk about that this analysis calls for democratic public engagement as well as individual control as a value for thinking about what to do with this information and the inferences. And returning specifically to the context of credit, how can these legal norms that we're concerned about, the norm of equality, be applied sort of proactively in the process of determining credit access? And how can that get us to start asking questions about the mechanisms for both market and non-market ways that we distribute income?